Ella, Head of Global Investor Relations at the Kraft Heinz Company. I'd like to welcome you to our fourth quarter and full year 2024 business update. During the following remarks, we will make forward-looking statements regarding our expectations for the future, including related to our business plans and expectations, strategy, efforts and investments, and related timing and expected impacts. These statements are based on how we see things today, and actual results may differ materially due to risk and uncertainties. Please see the cautionary statements and risk factors contained in today's earnings release, which accompanies these remarks, as well as our most recent 10-K, 10-Q, and 8-K filing for more information regarding these risks and uncertainties. Additionally, we will refer to non-GAAP financial measures, which exclude certain items from our financial results reported in accordance with GAAP. Please refer to today's earnings release and the non-GAAP information that accompany these remarks, which are available on our website at ir.kraftheinzcompany.com under News and Events for a discussion of our non-GAAP financial measures and reconciliations to the comparable GAAP financial measures. Today, our Chief Executive Officer, Carlos Abrams-Rivera, will provide an update on our overall business performance. And Andre Maciel, our Global Chief Financial Officer, will provide a financial review of the fourth quarter and will discuss our 2025 outlook. We have also scheduled a separate live question and answer session with analysts. You can access our question and answer session at ir.kraftheinzcompany.com. A replay will also be available following the event through the same website. With that, I will turn it over to Carlos.
Thank you, Anne-Marie, and thank you all for joining us today. I would like to start with a big thank you to the Kraft Heinz team for working tirelessly in what proved to be a challenging year for us and for the industry. Together, we maintain our focus on building and investing for the future. We have demonstrated our ability to be efficient cash generators, delivering both industry-leading gross margins and strong free cash flow. We have delivered efficiencies to fuel investments that are driving meaningful product renovation and innovation and enhancing our marketing capabilities, all of which are helping us build brand superiority. And despite a weaker macroeconomic backdrop, we returned meaningful capital to our stockholders in 2024, with $2.7 billion returned through our dividend, which offers the highest yield in food and share buybacks. As we look ahead to 2025, we remain confident in our strategy. By building upon the advancements made in 2024 and executing with excellence, we anticipate improvements each quarter in our top-line performance. This will be driven by growth in emerging markets and global away from home, with U.S. retail benefiting from actions we are taking to further implement our brand growth system. And we will do this while preserving profitability, something we have proven we know how to do well. With that, let us turn to our 2024 full-year results. Organic net sales declined 2.1% versus the prior year. Through the lens of our strategic pillars, this was driven by the growth in emerging markets, which was more than offset by declines in North America retail and away from home in the U.S. Despite the top-line pressure, we generated 100 basis points of adjusted gross profit margin expansion versus 2023. This was due in large part to the capabilities we have built over the years, including investment in technology that are driving efficiencies across areas like revenue management, manufacturing, and logistics. These efforts enable us to deliver nearly $750 million in gross efficiencies, a portion of which was reinvested in our brands. We remain committed to a disciplined approach to investing, ensuring that our resources are driving sustainable, long-term volume growth. Our gross margin expansion, in addition to a benefit from lower variable incentive compensation for the year, contributed to adjusted operating income growth of 1.2%. The reduction in variable incentive compensation reflects our culture of meritocracy, where performance is closely tied to rewards. This demonstrates the effectiveness of our compensation model in aligning pay with results. Our adjusted operating income growth, along with share repurchases, led to adjusted EPS growth of 2.7%. Finally, free cash flow came in at approximately $3.2 billion, an increase of 6.6% versus the prior year. Moving to the details of our performance across the three strategic pillars. In our accelerated platforms in North America Retail, organic net sales declined 2.9%. This was primarily driven by weakening trends in three specific brands and the planned exit of our unprofitable bulk vinegar business. This overshadowed strong performances across our Ore-Ida, Taco Bell, Philadelphia, and Heinz brands, which together make up about 40% of sales in U.S. Retail Accelerate. In Global Away From Home, organic net sales declined 0.6%. Growth in international away from home was more than offset by a decline in the U.S. This decline was driven primarily by two planned business exits for margin-diluted businesses, a temporary plant closure in the second quarter, and softer traffic trends relative to 2023. In the fourth quarter, Global Away From Home came in below our expectations. To improve our performance in 2025, we are committed to providing additional value to our customers. We will be increasing our investment in trade alongside our marketing initiative. And through our premium loyalty program, Heinz Verify, we will provide customers with access to bundles, traffic-driving promotions, and our state-of-the-art culinary portfolio and equipment. Turning to emerging markets, we grew 4% versus full year 2023, driven by both price and volume mix. Excluding pressures experienced in Brazil and China, the rest of emerging markets grew double digits in line with our long-term algorithm. In the fourth quarter, emerging markets organic net sales came in below our expectations, driven primarily by performance in China, where consumer confidence continues to remain soft. As a result, we saw more than anticipated inventory deloading as retail customers and distributors are reducing working capital and cost. Now, going a bit deeper into our North America Retail business. Last quarter, we discussed a couple of core categories that are driving year-over-year top-line pressure, including Lunchables, Kraft Mayonnaise, Kraft Mac and Cheese, and Capri Sun. Across each of these brands, we have kicked off the brand growth system, running deep, forensic-like assessment that will uncover the most meaningful opportunities to drive brand superiority. We are confident that the brand growth system will make a meaningful difference because we have already seen its success in action. In 2024, we ran pilots on Philadelphia cream cheese and Heinz in the UK. On Philadelphia, we captured wide space in growing channels with 13% growth in club. And on Heinz ketchup in the UK, we grew volume share by 2.3 percentage points, a category we haven't grown share in 5 years. We are now scaling this approach across these 4 brands, with dedicated agile pods already in place for each. And importantly, we are committed to making necessary investments in the products and marketing to close those gaps. In parallel to starting the brand growth system, the initial actions we have taken are showing early signs of traction as we're investing in the products to drive superiority. On Lunchables, we are strengthening the core and expanding the occasions. Take, for example, our recent launch of Spicy Nacho, which is 17% incremental to the meal combos category, driven by increases in both buy rate and consumption. We also continue to renovate as part of our ongoing commitment to deliver exceptional quality, including upgrades to our cookies and crackers to meet evolving taste. In our mayonnaise business, we are strengthening our value proposition to re-engage with lapsed users and to attract new ones. We are bringing new flavors, including pickle mayo, which has successfully rolled out in the U.S. And we're taking this flavor expansion strategy globally, launching new flavors in countries including Canada, Australia, the UK, and the Middle East. In addition to our flavor strategy, we are delighting consumers with better-for-you options through our Primal Kitchen brand. For Kraft Mac and Cheese, we are connecting and engaging with families and younger consumers. We are doing this through the new bold flavors like ranch and jalapeno, better for you options, new pack sizes, and on-pack partnerships. And we are seeing momentum here with a 1 percentage point improvement in the year-over-year sales trends. And finally, on Capri Sun, I am very excited that we have generated a 5 percentage point improvement in year-over-year sales. We invested in the product innovation to win on taste, and now we're bringing value to consumers through innovation, including a new 64-ounce multi-serve and our single-serve bottles. Our accelerate platforms represent the most attractive spaces within our portfolio, where we have the highest right to win, and in turn, where we have been prioritizing our investments. This prioritization has contributed to growth across several of our iconic brands, including Philadelphia, Heinz Ketchup, Ore-Ida, and Taco Bell. As I mentioned earlier, Philadelphia is one of the brands we piloted in our brand growth system in 2024. We uncovered opportunities to attract under-indexed audiences, to expand distribution in white space channel, and to highlight the versatility of cream cheese across new usage occasions. Our initial learnings and actions are yielding results, with 2% dollar growth sales despite lapping private label out of stocks in 2023. And Heinz Ketchup grew dollar sales 2% versus 2023. This was driven by impactful marketing campaigns and by increasing distribution from innovation. We have innovated across formats and flavors to deliver on consumer desires, including the successful launch of our pickle ketchup, which has been 50% incremental to the flavor ketchup category, and we are now expanding it to 4 continents. On Ore-Ida, we have been able to meet the strong consumer demand for our products, which in turn enable us to increase investments in marketing and promotions. This contributed to dollar sales growth of 8% in 2024. Lastly, Taco Bell had a great year, growing 24% versus 2023. This was driven by expanded distribution and share gains on both existing products and innovation, as we doubled down on the fast-growing Mexican cuisine category, growing at a pace of 4.5%. Turning to our next strategic pillar, global away from home. Despite the decline in our top-line growth, we are seeing wins across each key area of our strategy, growing in higher margin channels, increasing penetration beyond ketchup, and go-to-market excellence. In the U.S., we gained 70 basis points of share and grew sales mid-single digits for the full year across higher margin, non-commercial channels. This includes wins in entertainment and travel. Earlier this year, we announced a new multi-year partnership with the Chicago Cubs, where Heinz has been named the official condiment of Wrigley Field. This included incremental distribution on Heinz Ketchup, mustard, relish, and more. I am also excited to share that we have signed a new contract with Hilton Hotels, making Kraft Heinz the preferred vendor for sauces and condiments globally. This presents a large opportunity for us, and we are excited for the doors it unlocks, partnering with Hilton to leverage their worldwide presence in over 130 countries to drive growth. We also continue to expand beyond ketchup. I just mentioned our partnership with the Chicago Cubs. This is one example where fans can also enjoy Kraft Mac and Cheese, Philadelphia, and Primal Kitchen throughout the ballpark. And more recently, we further increased our penetration of Philadelphia cream cheese in away from home with Dunkin'. In U.S. away from home, we grew Philadelphia cream cheese high single digits in 2024. And we are focused on go-to-market excellence, leveraging our proven model to not only gain distribution in retail within emerging markets, where we have solid coverage, but also expanding the model into away-from-home channel. In 2024, we grew total distribution points in emerging markets away from home by 21%. As you can see, our away-from-home team has been busy this year, and I'm happy to report that for 2025, we have already locked in 75% of the expected sales from new client wins. Looking at emerging markets, we grew organic net sales both in the fourth quarter and the full year. While this growth was lower than we originally anticipated due to pressures in Brazil and China, the rest of emerging markets grew double digits, a testament that our strategy is working. Our growth drivers in emerging markets are twofold: leveraging the strong brand equity of our Heinz brand and expanding distribution through our go-to-market model. We grew Heinz organic net sales in emerging markets approximately 8% in 2024. Heinz is our largest brand globally, and it represents over $1 billion in sales in emerging markets, accounting for roughly 40% of total sales in the zone. We also continue to expand distribution through our go-to-market model. We increased total distribution points by 17% in 2024 and plan to further increase by an additional 40,000 points of distribution in 2025. This sets us up well for accelerated growth. As we look to 2025, marketing and innovation will be key enablers of our growth. Let's dive into both. First, on the marketing front, we continue to make meaningful advancements in talent, tools, and capabilities by building an ecosystem that fuels brand relevance and creative excellence. A key driver of this success is our in-house agency, The Kitchen, which we launched 4 years ago to unlock creativity and deliver breakthrough ideas at the speed of culture. Since its launch, The Kitchen has garnered external recognition, earning numerous awards for the in-house agency of the year. I am thrilled to share that our marketing team has been pushing the boundaries of innovation and creativity in the partnership space. We're not just talking about any partnership. We are talking about game-changing, culture-shifting collaborations that are redefining the marketing landscape. For example, we finally got Mustard on the Beat with our electrifying collaboration with the award-winning producer Mustard, which dropped during the biggest night in music, the Grammys. And if that wasn't enough, we also brought our beloved brands to life in Instacart's first-ever Super Bowl campaign, featuring the iconic Heinz Wiener Dogs, the Kool-Aid Man, and the Oscar Mayer Wienermobile. It was a moment that will go down in marketing history. These partnerships aren't just about generating buzz. They're about creating unforgettable experiences that leave a lasting impact on our consumers. And I couldn't be prouder of our team for their dedication to truly creating marketing that excites. Our brand growth system is another critical component of our creative ecosystem, providing a systematic and repeatable framework that complements our disruptive marketing and innovation efforts to drive brand superiority. You have heard that about the early success we've had with Heinz ketchup in the UK and Philadelphia cream cheese in the US. Now, with this pilot complete, we are ready to scale. More on that as we get into candy next week. Turning to innovation, our strategy is working. We have significantly increased innovation as a percentage of our organic net sales from 1.6% in 2022 to 2.9% in 2024. We are focused on creating and providing consumers with products that are worth paying for, whether that be through our cuisine and flavor exploration, high-quality convenience solutions, or expanding options and functionality through unique benefits. As part of our Mexican food strategy, we have expanded our Taco Bell partnership, providing our consumers with restaurant-quality experiences at home. In 2024, this led to dollar sales growth of 24%, and we increased market share by nearly a point. As consumers are looking for bolder, more exciting flavors, we are leveraging a flavor-focused expansion strategy in mac and cheese. Based on market and social media trends, we are creating buzzworthy moments by launching limited-time offerings to drive excitement and deliver unexpected new flavors to market in record time. This includes our most recent Everything Bagel Kraft Mac and Cheese launch, which sold out in just one day online at one of our largest retailers. After 150 years, leveraging our extensive agricultural heritage and tomato expertise, we launched the first Heinz pasta sauce in the UK a couple of years ago. Now, we continue to introduce new recipes, disrupting and driving excitement in the pasta sauce category, making superior quality ingredients and the latest food trends accessible to all pasta lovers. And it's working, with dollar sales growth of 45% in 2024. And by leveraging a global Heinz team that was established last year, we are quickly scaling what works, expanding Heinz pasta sauce into other countries, including Brazil, Chile, and across Europe. And we are delivering deliciousness and convenience through a 360 crisp platform, pushing the boundaries of what frozen food can deliver. This patent technology provides convenience and quality, creating crispy products like those on the stove in a matter of minutes in the microwave. Deli Mex Quesadillas marked our first launch on the brand in over 5 years, and they are now available in over 20,000 stores as we continue to expand distribution. We entered 2025 with strong momentum on the innovation front, and we will continue to double down on innovation that worked well in 2024. In fact, over 75% of innovation sales in 2025 are expected to come from proven innovation already launched. Plus, we have an exciting array of launches ready for 2025, focused on our core brand. With that, let me hand it over to Andre to provide more details on our fourth quarter financial results and to discuss our 2025 outlook.
Thank you, Carlos. In the fourth quarter, organic net sales declined 3.1% for total Kraft Heinz, with price up 1 percentage point and volume mix down 4.1 percentage points. In North America, organic net sales declined 3.6%, with growth in our Canada business offset by lower sales in both U.S. retail and away from home. In our international developed markets, organic net sales declined 4%. This was driven by volume pressures due to customer negotiations in Europe and declines in non-core categories. In emerging markets, organic net sales was up 2.2%. Results were impacted by Brazil, driven primarily by volume elasticity linked to price taken in commodity categories, and China, where we continue to experience industry softness. The rest of emerging markets grew the top line double digits in the fourth quarter, with particularly strong growth in the Middle East and Turkey. Turning to the next slide, total Kraft Heinz adjusted operating income declined 0.3%, driven by declines in each of our zones, primarily due to lower sales. Our adjusted operating income margin increased 80 basis points, a result of lower variable compensation and unlocked efficiencies. Lower variable compensation was a benefit to adjusted operating income across each of our zones. In North America, adjusted operating income declined 2.3% versus the prior year, with declining sales more than offsetting productivity gains. In international developed markets, adjusted operating income decreased 3.8%, primarily driven by the decline in sales and incremental inflation, partially offset by operational efficiencies. In emerging markets, while adjusted operating income declined 0.8%, on a constant currency basis, we grew 3.5%, and adjusted operating income margin expanded by 70 basis points. This growth and margin expansion was driven by lapping elevated investments in go-to-market, primarily in LATAM. As we think about improving overall competitiveness in the market, we are leveraging a combination of strategies. We are focused on growing our base volumes in a sustainable way. This includes through consumer-driven innovation, portfolio renovation, marketing that matters, as well as selectively investing in price. In the fourth quarter, our percent of volume sold on promotion was down 2% versus the prior year. This was primarily driven by lapping dynamics. In the fourth quarter of 2023, we were investing more in promotions on Ore-Ida as we were coming back from service issues, and in Philadelphia, we are lapping private label out of stocks. As we continue to balance long-term profitability, our volume sold on promotion was 5% below levels that of 2019. Looking to 2025, we are planning an increased level of investment in price, remaining mindful of the consumer situation, we plan to make investments to adjust price gaps in selected categories, primarily across the 4 key brands Carlos discussed, adding now U.S. away from home. While we'll be investing more, we are also taking actions to ensure we generate positive returns. We have additional opportunities identified for 2025 to remove non-effective events that were not driving top or bottom line in 2024. And we know that promotions without product improvement and marketing will not get us to where we need to be. Moving down the P&L, we continue to generate margin expansion through end-to-end efficiencies. This helps us to not only offset inflation, but it also enables us to invest in the business to support long-term growth. In 2024, we generated nearly 4.5% of gross efficiencies as a percentage of cost of goods sold. This exceeds the target we had for the year, and we are well on our way to achieving our goal of $2.5 billion in efficiencies by 2027. With $1.3 billion unlocked to date, we have significant runway ahead to capture at least $1.2 billion more. Through Agile at Scale, we have plans for further advancements, including but not limited to automation and network optimization in our supply chain, sourcing excellence within procurement, and maintaining a disciplined execution and continuous improvement mindset. These efficiencies helped generate 100 basis points of adjusted gross profit margin expansion in 2024 and provided us with the flexibility to increase investments. We exited 2024 with marketing as a percent of net sales at 4.5% and R&D as a percent of net sales at 0.6%. On the marketing front, we are approaching optimal levels and are shifting more focus in 2025 on unlocking additional value from our marketing spend through data-driven improvements to ROIs. We have plans in place that will optimize marketing mix across brands and media types to ensure our dollars are working hard for our brands. On R&D, we expect to further increase our investments to support future innovation and are targeting levels closer to 1% of net sales. Turning to cash flow, we generated full-year free cash flow conversion of 85%, a 4 percentage point increase versus the prior year. This was primarily driven by the conversion of certain surplus plan assets related to the U.S. post-retirement medical plan to cash, as well as improved working capital. At the same time, we continue to increase investments for growth, with full-year CapEx increasing to 4% of net sales, up 20 basis points from the prior year. In terms of adjusted EPS, we grew 7.7% or 6 cents versus the fourth quarter of 2023. This was driven by positive impacts from a lower effective tax rate and share repurchases. Keep in mind, our adjusted EPS does exclude an impairment charge of $1.4 billion that was recognized in the quarter, which was more than offset by a $2.4 billion tax benefit. This tax benefit is related to the transfer of certain business operations that was completed in the fourth quarter of 2024. The transfer was part of our planning for the changes in the international tax environment and also allowed us to achieve greater operational synergies. In accordance with GAAP, the P&L benefit from the transfer of certain business operations had to be recorded in the fourth quarter of 2024 when the transfer was completed. On a cash tax basis, however, the benefit is recognized annually starting 2025 and going forward for the next 20 years. As a result, we expect a 500 bps step up in our P&L tax rate starting 2025. However, we only expect a 200 to 300 bps step up in our cash tax rate. and we continue to maintain a strong balance sheet while returning capital to stockholders. In 2024, we maintain our net leverage target of 3 times, ending the year at 2.9 times. We believe this is a good level that provides us with optionality. We also return approximately $2.7 billion to stockholders, $1.9 billion through our competitive dividend with a yield that exceeds 5%, and $800 million through our share repurchase program. This leaves about $1.9 billion remaining against our $3 billion authorization. As a reminder, our share repurchase program is non-programmatic, a function of excess cash, and takes into consideration the macroeconomic environment. Now turning to our full year 2025 outlook. We are expecting organic net sales in the range of down 2.5% to flat. This includes full-year growth in our emerging markets and global away-from-home pillars, with an elongated recovery expected in U.S. retail challenged categories. We expect organic net sales in the first quarter to come in lower relative to the fourth quarter of 2024. This is driven primarily by an approximate 100 basis point headwind for total Kraft Heinz due to an Easter shift. As a result, we expect to see lighter sales in the first quarter with an offset in the second quarter. The second quarter should also benefit from lapping pressures on Lunchables performance and the temporary plant closure in the second quarter of 2024, as well as increased investments in price and product. We then expect the second half to gradually improve from the second quarter. Constant currency adjusted operating income is expected to be down 4% to down 1%. This includes the impact of lapping lower variable compensation in 2024, which is an approximate 210 basis point headwind at the midpoint of our guidance. This also contemplates an adjusted gross profit margin that is flat to slightly positive year over year, driven by our gross efficiencies that are mostly offset by incremental investments in price and product. We expect adjusted EPS to be in the range of $2.63 to $2.74. This reflects a 7-cent headwind versus the prior year from lower variable incentive compensation in 2024. Our adjusted EPS expectation also contemplates an effective tax rate of approximately 26%, which is a 23-cent headwind on adjusted EPS year over year. The step up in our effective P&L tax rate is primarily related to the dynamics I noted earlier. As a reminder, this outlook does not reflect any impact from future potential share repurchases. From a free cash flow perspective, we expect 2025 to be flat versus prior year, with free cash flow conversion of approximately 95%. This is driven by working capital efficiencies and lower cash outflows for variable compensation, partially offset by the net cash impact of a higher tax rate. We also want to acknowledge that the macroeconomic landscape remains uncertain, particularly as it relates to potential tariffs, food regulations, changes to SNAP, and foreign exchange headwinds. Our current outlook does not contemplate significant worsening of these macroeconomic pressures. With that, I will pass it back to Carlos for some closing comments.
Thank you, Andre. At Kraft Heinz, we're acting with urgency, building upon our proven ability to unlock efficiencies, benefiting from 2024 foundational accomplishments in our strategic pillars, and investing for the now and the near to support the next. We have established our ability to be an efficient operator. Through the capabilities we have developed, due in large part to our agile ways of working, we are generating best-in-class efficiencies with $1.3 billion captured to date, with line of sight to an additional $1.2 billion. These efficiencies, along with working capital improvements, have led to an increase in free cash flow conversion from 81% in 2023 to 85% in 2024, with expectations to increase to approximately 95% in 2025. Last year, our teams were busy laying a solid foundation for 2025. Our top-line improvements in the year will be driven by building upon the momentum of strategic growth drivers, leveraging initiatives already set in motion. Earlier, I talked about a couple of our successful innovation launches across Heinz, mac and cheese, and our Mexican strategy. As we think about 2025, over 75% of the forecasted sales from innovation will come from launches already proved out. In away from home, I am excited to enter the year with 75% of expected sales from new customers wins already locked in, and a strong line of sight to additional customer wins as we progress throughout the year. In emerging markets, we will continue to execute against our go-to-market model in both retail and away from home, building upon continued distribution gains. With significant white space and a proven plan in emerging markets, we have meaningful opportunities to continue to grow. And what really excites me is we completed 2 successful pilots of our brand growth system. Although it's still early, we are seeing promising initial results across Philadelphia and Heinz in the UK. And in 2025, we will be investing for the now and near to support the next. We are scaling a brand growth system, utilizing agile scale ways of working to grow our core must-win brands. This deep forensic-like assessment of our brands uncovers meaningful opportunities to invest in the product, ensuring that we are driving superiority on all fronts, delivering on consumer desires, and creating marketing that resonates with consumers. And importantly, we are dedicated to making these investments while protecting profits. We're also honing in on our sales capabilities, ensuring our products are available and visible wherever, whenever, and however a consumer wants. This includes strengthening our capabilities across our go-to-market model and joint business planning to drive further distribution and reach. All of this combined, along with our highest employee engagement yet, being named a great place to work in 22 countries, including in the US for the first time, gives me excitement headed into 2025. I know we got some work ahead of us to really drive growth, but I gotta tell you, I am feeling pretty optimistic about the momentum we have built. We're making strides, and that's something to be excited about. As we look to the year ahead, I'm confident that we got the right strategy in place. We'll keep innovating, we'll stay focused, and we'll keep driving towards our goals. Together, I'm excited to see what we can achieve. Thank you for your time and interest in Kraft Heinz.
Kraft Heinz Company, Quarter 4, 2024 earnings. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce Anne Marie Magella. Thank you, Anne. You may begin.
Thank you, and hello, everyone. During today's call, we may make forward-looking statements regarding our expectations for the future, including items related to our business plans and expectations, strategy, efforts and investments, and related timing and expected impacts. These statements are based on how we see things today, and actual results may differ materially due to risk and uncertainties. Please see the cautionary statements and risk factors contained in today's earnings release, which accompanies this call, as well as our most recent 10-K, 10-Q, and 8-K filings for more information regarding these risks and uncertainties. Additionally, we may refer to non-GAAP financial measures, which exclude certain items from our financial results reported in accordance with GAAP. Please refer to today's earnings release and the non-GAAP information available on our website at ir.kraftheinzcompany.com under News and Events for a discussion of our non-GAAP financial measures and reconciliations to the comparable GAAP financial measures. I will now hand it over to our Chief Executive Officer, Carlos Abrams-Rivera, for opening comments. Carlos, over to you.
Well, thank you, Marie, and thanks everyone for joining us today. I want to thank the Kraft Heinz team for their hard work and dedication this past year. Even though it was a tough year, we stayed focused on building for the future and improving profit margins while boosting the free cash flow. We do know that the economic landscape was rough, but we are proud that we returned $2.7 billion to our stockholders through share buybacks and dividends, which provide the highest yield in the food industry. Looking ahead to 2025, we are seeing key successes that aren't yet showing up in our financials, and we're expected to see improving top line throughout the year while preserving profitability. Frankly, I'm proud of the progress the teams are driving and confident that our strategy will yield long-term returns for our shareholders. Now, with that, today I have Andre joining me, so let's open for the call for the Q&A.
Great, thank you. We'll be starting the Q&A session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 to remove yourself from the queue. For participants using speaker equipment, it may be necessary to pick up the handset before pressing the star keys. One moment while you poll for questions. And our first question comes from Andrew Lazar with Barclays. Please proceed with your question.
Great. Thank you so much. Carlos, you mentioned a number of times in the prepared remarks the plan to be disciplined in how you approach reinvestment this year, specifically calling out your expectation for some gross margin expansion and flat price in 25, despite the stated plan to invest in price in some key areas. I guess what I'm hearing most from investors this morning is that they're really wondering if this outlook provides enough room to do what's needed this year to get the key brands back into volume growth. So I guess my question is, sort of what gives you the confidence that this plan is accounting for, an adequate level of investment given sort of current market share trends? Thanks so much.
Thanks, Andrew. I think, first of all, I guess let me put it into context of the margin expansion. If you think about 2024, we increased our margin by 100 basis points. When you look at the way we're thinking of 2025, it's somewhere between flat to 20 basis points. So while yes, it's an expansion, it certainly is much reduced than we have had in the past. And if I think about now our plan and what gives me confidence, let me just highlight a couple of things. First, if you think about our growth pillars, we actually have a head start going into this year. And let me break it down in each of the growth pillars. In away from home, 75% of new customer wins are already locked in. That's about 40% of a year-over-year incremental growth in our away from home business. Now, in emerging markets, we are building on the 17% distribution increase with new 40,000 additional points planned in 2025 that we have already mapped out and making sure that our teams are clear on where they're going to be able to secure those. And then, frankly, in North America retail and the rest of the business, what you see is that 75% of the 2025 innovation pipeline is already locked in. So, and on top of that, we also are leveraging our brand growth system that we have proven through the pilots that we did in 2024. So in each of our pillars, we have things going on already into 2025 that is about us continuing versus completely something new. And at the same time, and you mentioned this in your question, we are investing in certain places. We are investing in price. We are investing in product, and we are investing in marketing. We're making sure we're prioritizing those brands that where we know that we can benefit from having the brand growth system insights. We are investing in technology-led solutions that are actually helping us drive the efficiencies that leads to improved margins. And then lastly, we continue to shift more marketing dollars towards consumer-facing marketing as we go into 2025. So again, that's the way kind of I see it, is it gives an opportunity for us to expand in a more modest way our margins, but at the same time coming into the year with things that we have built in 2024 that now we can still see reaping benefits in 2025, along with investment specifically in price, product, and marketing.
I'll just add to that. Good morning, Andrew. So I will add that when you think about our top line improvement, as Carlos said, it does not only come from price. It comes also from lapping some of the challenges we faced last year, and also comes from all the product enhancements that we have been deploying since the second half of last year. When you think about the gross margin, we do expect another year of efficiencies higher than inflation, and we are going to price the inflation linked to commodity categories, coffee being one example, like we have done historically. So there is some price embedded into the plan in commodities and emerging markets. So the combination of efficiencies ahead of inflation, price in emerging markets and commodities give us some room to be investing more in price or trades in the places where it makes the most sense.
Great. Thanks so much. Appreciate the color.
Thank you. Our next question comes from Peter Galbo with Bank of America. Please proceed with your question.
Hey, good morning, Carlos and Andre. Thank you guys for the question. I wanted to ask about the top line and the pillars maybe in a slightly different way. Just within the organic sales guidance for 25, Andre, how are you thinking about the growth rates for each accelerate, protect, and balance within that organic sales guidance? And then the part B to that question, Carlos, I think a year ago you kind of gave us market growth rates for each of those, accelerate, protect, and balance. How you see, the market growth for 25 comparing to those targets you gave us a year ago. So thanks for the color on both of those.
Okay, I can start. Good morning. So I think about the pillars of growth. First, emerging markets. We will see gradual improvement building from Q4 in all the quarters, and we do expect to exit 25 at double-digit growth. In away from home, we do expect some slight improvement in Q1 to flat to Q4, but then building from the base gradually throughout the rest of the year and probably exiting around the mid-single-digit territory, so still below algo, but a good improvement versus 2024. And inside the accelerated platforms in the U.S., we do expect an elongated recovery, as I have said before, and most of the U.S. improvement in trends in retail comes from accelerates. So that's where we are investing most of the price. That's where we are investing a lot of our product enhancements. So that's where we're going to see, you should see a sharper improvement again throughout the year. Not as much in Q1 for the reasons I already mentioned before. I think investments get more concentrated from Easter, and also there is the Easter effect between Q1 and Q2. But at the end of the year, you should see accelerate being the one driving most of the improvement in the U.S.
What I would add is, I think we all can agree that tactics wins battle, but strategies wins wars. And our strategy hasn't changed. We have not only continued to drive resources and prioritizing our accelerated platforms, but also making sure that a year later, we continue to live under the roles of each of those particular categories. So I feel great about the fact that we see kind of how our balanced portfolio continues to live into the role of making sure they're contributing with the right margins, at the same time making sure that they are bringing renovation and innovation into the categories to make sure they're relevant with consumers. But again, our strategies haven't changed, and any 1 year is not gonna make us change that. I think that as we stand here, I'll tell you, I feel even more confident that we have this right strategy for us to deliver our long-term algorithms over the long term.
Thank you.
Thank you.
Thank you. And our next question comes from John Baumgartner, Mizuho Securities. Please proceed with your question.
Good morning. Thanks for the question. I wanted to ask about.
Morning.
Good morning. I wanted to ask about the marketplace activities in the U.S. and the market share softness. As you've reduced the unprofitable trade, which is net positive for margins, are you getting the sense that maybe your consumers have become a bit more accustomed or trained to buy on deal, a bit more for your, or you're reinvesting elsewhere, whether it's in marketing or display? The lifts on that, are just sort of insufficient to counter the volume drag. I'm just curious if maybe making these changes to promo is a bit more painful up front than you had anticipated with the elasticity to the consumer.
There is I think, as we said throughout last year, I think not all promotions are working the same as they used to. We do believe that base volume has also a significant implication on the size of lifts that you observe. So base volume is an area that you're paying too much attention to, especially, again, a lot of the product enhancements should help that base, which should give us a stronger starting point for the lifts to come up. There are places where we are contemplating as well base price changes instead of simply a promotion. So there is a discussion in some categories that might make more sense one versus the other. And on promotions, again, we have seen typically higher frequencies working better, not necessarily deeper discounts. You're going to see some of that reflected as we head into next year.
The only thing I would add, this is Carlos, it was, one of the things that we continue to see is consumers increasing the number of locations in which they buy their food. So we are seeing, smaller size of baskets per trip, but an increase in the number of trips. So for us, it's also important not just to make sure that we have the right price, but that we also have right distribution in different channels in the U.S., which is why our expansion in dollar channels, in our club channels, where we actually are seeing growth as well too. So for us, it's making sure that, again, we have that combination on where the consumers are shopping at the right price point for us to make sure that we are attracting the purchases for consumers at the moment they need it.
Okay. Thanks for the question, Andre.
Thank you. And our next question comes from Ken Goldman with JP Morgan. Please proceed.
Hi, I wanted to dig in a little bit on the increase in your tax rate, if I could, into 25. We've heard from a number of multinational food companies and beverage companies in the last couple of weeks. I don't think any of them have really talked about quite the increase in tax that you're about to experience. I didn't know if there's anything unique in how you had previously considered tax in some of these other countries that we should consider, or if there's anything about that's slightly different in how you approach the way you think about tax rate and so forth, with the understanding that, of course, your cash tax rate isn't going up quite as much. So just wanted to get a little bit of color there. It just seems a little bit more unique to Kraft than what we might have expected, given the size of the announcement. Thank you.
Good morning. Look, I think companies have different strategies when it comes to taxes, so it's difficult for me to comment on what others have. We did have a more competitive tax rate in the P&L compared to other peers. You can see that very clearly. We had to record in December, in Q4, a $2.4 billion tax benefit in the P&L, in net income this quarter. And that's linked to a transfer we did in a certain business operation. And that was part of the efforts to reduce the cash impact of several countries enacting the global minimum tax regulation. So we did have this relevant benefit in the P&L this year, but as a consequence, the tax rate in the P&L will have a 500 bips increase starting 25. On the flip side, the $2.4 billion P&L gain will translate into approximately $120 million cash gains per year for the next 20 years, which makes the impact in our cash tax rate, which ultimately is the one that I'm most interested at, being about 200 to 300 bips. Okay, so you will see this is one of the reasons, not the only, why also our cash conversion is expected to be around 95% into 25.
Thank you.
Thank
and
you.
Our next question comes from Leah Jordan with Goldman Sachs. Please proceed with your question.
Thank you. Good morning. I wanted to ask about Lunchables, just seeing if you could provide an update on how you see the recovery in that business. I know you had a supplier issue in the fourth quarter. It seemed like it was going to be resolved in 1Q, but the January data does still look a bit soft. So how should we think about the improvement from here? You know, is it more just needing price adjustments, or is it more of a step up in innovation as you're planning? And then just any color on the competition you're seeing in the category from private label and smaller brands.
Well, thank you for the question. You know, first I would say is that the supplier ingredient issue that we faced in Q4 still lingers through Q1. We will exit Q1 in a much better location in terms of service. So I think that you still see as we see the data in January, but again, as we go through the quarter, that will improve significantly. Now, in terms of the overall category, what I'll say is, you know, our focus has been how do we continue to invest in the business that we believe in can be a great source of growth for us as a company. And I'm proud of the fact that the team have been looking at using our brand growth system, looking at the places that actually can solve different pain points for consumers. So you'll see as we go into the rest of the first half, a product that is much improved with better quality, better ingredients, and us continue to bring different innovation and marketing to our Lunchables business. So I think what you see right now, don't think of that as a sign of how the year is going to be, but you'll see that still is a lingering effect of that of Q4.
Yeah, if you look at the sellout December and January, for example, for Lunchables, there are 4 SKUs in particular that are linked to the upstream supplier issue that we mentioned, that are declining more than twice the average rate of Lunchables as a whole. So, and those are dragging the sellout down quite a lot in these last 2 months. We do expect that to continue to happen into February. We think the service issue will be fully resolved during the month of February, and then we're going to see gradual recovery on the sellout from that point onwards.
Thanks for the question.
Thank you. And our next question comes from Tom Palmer with Citi. Please proceed with your question.
Good morning. Thanks for the question. I wanted to just ask on, and this is a little bit of a follow-up, but on the organic sales growth and inflection as the year progresses, I think the comment in the prepared remarks was sequential improvement throughout the year. It sounds like the second quarter has maybe some unusual timing benefits with the Easter shift and then also lapping the plant downtime from a year ago. So just trying to understand, are we looking for kind of in underlying sales trends, this bigger inflection starting in the third quarter to overcome that? And if so, kind of what are the key drivers of that inflection? Thank you.
So, good morning. Thanks for the question. So, yes, in the second quarter, you should see a relevant improvement on the trends, not only because of Easter being about 100 bips shift from Q1, but also we start to lap the factory closure, temporary closure we had in the quarter. We start to lap that Lunchables report that was issued early in April. So those 2 things alone these 3 things alone will have a relevant improvement in the trends. Plus the fact that, as we mentioned before, price investments start more pronounced as we head into Easter and beyond. And as we continue to launch some product enhancements, in Lunchables being one of them.
Thank you. And our next question comes from Michael Lavery with Piper Sandler. Please proceed with your question.
Thank you. Good morning. I wanted to ask a similar question to Andrew's, but with the advertising as opposed to promotional spending. You pointed out the 4.5% level, but that does include market research and even for peers, excluding that, the advertising level is averages closer to 5 or more. Is your marketing spending enough? And I know it's come up, but with the just competitive and consumer dynamics, is that at the right level? Does there need to be some upside to that figure as well?
Listen, I guess I will start by saying, and thank you for the question, it's not all brands, not all countries are created equal. So I think one of the things you see is that we're also making sure that some of the analysis that we have done in the past years is that we have kind of the right levels of marketing in different categories and in different countries based on our needs and what it means to be successful. The second thing that you should also know is that we talked about earlier, we have especially designated categories to accelerate, protect, and balance. Our marketing dollars are going to continue to follow that. That is part of the strategy of us making sure we invest in those businesses that we believe have a bigger tailwind as we go forward. So again, in a different level of spending by different type of strategy. And the last thing I will say is one of our focus has been over the last 2 years doing two things. First, making sure that we improve the return of every dollar that we invest in marketing. And we have the analytical tools to allow us to do that. And second, that we continue to shift more dollar from non-working into working. So I think as we go into 2025, you'll see us that even though we may stay at the same levels of overall spending, there's actually a dramatic shift in terms of how much consumers will see in terms of our marketing as we are shifting away from, again, places of non-working dollars, being more efficient with those dollars so that actually can be beneficial to the brands.
And just to complement, as you have said before quite a few times, we do believe our sufficiency levels are around 5%, and we're going to gradually get there. But to Carlos' point, one of the benefits, among others, of the brand growth system that we are deploying now is shedding light on opportunity for us to be a lot better in the returns of the market investment. So you'll see in 25, we're going to release $60 to $80 million more marketing, like brand media marketing, which is quite a lot. It's more than a 10% increase in our overall media investment. That's coming from non-working dollars. And within the media, there is also a lot of efforts to redeploy media to places that provide higher return, be it about media levers or across certain brands. So even though the P&L will be flat on the percentage of revenue on a year-over-year basis, you see a lot more marketing pressure, which is important.
Okay, thanks so much.
Thank you.
And our next question comes from Chris Carey with Wells Fargo Securities. Please proceed with your question.
Hi, everyone. I wanted to ask, I guess, a bigger picture question. I think one of the things I personally struggle with is that the categories in which you compete are actually running more or less in line with historical growth rates. Not amazing, but more or less in line. And your business is just underperforming those categories in which you compete. And certainly there are specific categories that have had some issues, and you'll be lapping those, and surely that will be helpful. But it does feel like there's a bit broader of a dynamic underway. And I think that's where some of these questions are coming from around pricing, investments, and what's potentially needed in the acceleration of organic sales growth. I guess if you could diagnose what you think is driving some of this underperformance relative to categories on a broader level, whether that's execution whether that's affordability. And really what I'm getting at, I suppose, is say we're sitting here in a few months and we're not seeing the pickup. What is the correct action to take? Is it incremental pricing, incremental advertising, a rethink of execution? So I realize that's a big question, but I'd love your observations or thoughts on this topic. Thank you very much.
Thank you. Appreciate the question. I guess let me just start by putting things in perspective a little bit in terms of the way I see it. Our portfolio is about over 200 brands and over 240 countries. If you think about today where we see our challenges, they're concentrating in 4 brands and only in the U.S. retail business. And so it actually helps quite a bit for us to make sure that we are being focused on investments on products and pricing in order to drive top-line improvements, in particular those areas that, again, that are a subset of the large brands that we have and a number of countries that will participate. At the same time we're doing that, we're also being conscious of making sure we manage through our margins so that we don't go backwards in our gross margins. And in terms of the investment we're making, I think that it's easy for us to just point to the things that we actually have proven already. Let me give you the example of Capri Sun. We've actually improved 5 points in dollar sales in the fourth quarter. And that came about us renovating the product to make sure we win on taste, innovating, we bring in new multi-serve packaging, single-serve bottles, bringing value to consumer, expanding into convenience channel. And at the same time, we already seen how the multi-serve product in club is actually becoming a top quartile item. So for us we already have kind of a blueprint in which we have applied our brand growth system to the critical brands in order to see results that we will continue to see experience as we go forward. So I know that sometimes it can seem like a lot, but again, for us it's just specific, it's a few brands, it's in the U.S. retail, and it's places in which we are attacking, leveraging kind of the proven methodology that we have now developed through a brand growth system in order to drive top-line growth.
The only thing I'll add is, look, there is not one answer, like there is not a silver bullet. I think given the different categories that we play in different dynamics, the approach differs a lot. So there are places where, yes, it's affordability, and that's where we are going to invest the price the most to ensure that the price gaps are established. There are places which is about continue to invest in the products to maintain or increase product superiority. And that's where we see investments in places like Capri Sun Lunchables, and there are a few others. So you will see next week in CAGNY, I think that they are a good answer for what you're seeking for, because there is a lot of time in that presentation that we're going to be talking about our path to growth, given specific themes across the different platforms. So I think you're going to see what you're asking in more detail over there.
Okay. Yeah. Thanks, guys.
Operator? Thanks. Operator, we have time for one more question.
Okay, great. And our last question comes from Alexia Howard with Bernstein. Please proceed with your question.
Good morning, everyone.
Morning.
Okay. Can I hit on the GLP-1 topic? We've seen other protein-focused companies in North America already announcing plans to lean into the rising uptake of these GLP-1 injectable weight loss drugs. But first of all, do you believe Kraft Heinz is seeing any impact from them? And what opportunities are there to meet the unmet needs of these patients over time? Thank you.
Thank you, Alexia. I guess let me start with the last part of your questions. And no, we have not seen any meaningful impact from GLP-1 in the business. Now, we do know that consumers who do use GLP-1s, typically what they're looking for is more protein and more hydration alternatives. So, here at Kraft Heinz, we're making sure we continue to provide those choices for every consumer. And we've seen that, whether that is, making sure in our portfolio that we highlight in products like Oscar Mayer, Lunchables, P3, even our quesadillas and Deli Mex and our Heinz beans, the amount of protein that actually can deliver for consumer in a tasty and accessible and affordable way. And then at the same time, we're also making sure that we are continue to drive the importance of us elevating the portfolio of any product that has protein. So the fact that we have this taste elevation product platform within our company allows us to make sure that no matter what protein people are using at home, that we can actually elevate it and make sure that it delivers a great taste they're looking for. So I think you'll see us continue to emphasize this in our approach as we go forward, because for us it's important that we provide choices for every consumer and every lifestyle. Thank you, Alexia.
Thank you, everyone, for your questions. Thanks, everyone, for your questions today. We look forward to seeing you all at CAGNY next week.
See you next week. Thank you.
Thank you. This does conclude today's teleconference. We thank you for your participation. You may disconnect your lines at this time.